Thinking about buying a home or wondering if you missed your window? Mortgage rates, Fed decisions, and new tech are all shifting the market fast. Today, we're breaking down what's really driving it and what it means for you. I'm Nikki Foley, host of Paladin Financial Talk, and I'm joined by featured guest Jay Dacey of Jay Dacey Mortgage, who's a local mortgage broker and banker serving the Twin Cities of Minnesota. Welcome, Jay.
Thanks, Nikki.
All right. So, Jay, we are going to dive in today on a lot of things, but I want to talk a little bit about you before we do that. So
Sure.
I like to brag on you because I do have to say you've been here a few times.
Yep.
And every time we have you, we have great ratings because I think people really do want to know what's going on in the housing market around them. So let me do a few introduction pieces here. And then if you have more to add, we absolutely want to do that. So
right.
Jay is been in the mortgage industry 20 plus years. You've helped thousands of family navigate this since 2003, I think. Yep. is the right number there. You are the founder and leader of Jay Dacey Mortgage Team. You're serving clients all across Minnesota and in multiple states. You also have been nationally recognized and featured in major financial media outlets, known for your insights on lending, credit, and real estate trends. And just having conversations with Jay, you'll know how smart he is when it comes to all of this. It's fantastic to have him here. But you take a really holistic education approach to working with people and making sure that you're helping clients understand the strategy and kind of the bigger picture, long-term perspective on all of this. So, and you're recurring guests. I already said that. We love having you. So tell me, Jay, before we dive in, some of this lingo isn't as common to the layperson.
Sure.
And so you are a mortgage broker and a banker.
Yep.
Tell me what that means and what the difference is and what our listeners might want to know about some of that terminology.
Sure. So a mortgage broker doesn't have their own capital per se. So if you work with a broker, they're going to shop multiple lenders on your behalf. And essentially the major difference in our industry or business is that a mortgage broker, they collect their commission check at closing. They're paid at the title company when you sign your paperwork. A mortgage banker has their own capital, and so they're going to fund your loan and then resell it later that week or the next week to another institution, and that's when they get paid, is when your loan gets purchased for that first time. It's
Jay,
a major difference.
Very simple. I always appreciate that. And I have worked with you and I still didn't even know that. So you've probably told me this multiple times. So it's good to hear it on repeat. And so the difference between broker and banker is there any other terms that kind of fall into this overall that would be good to include in that?
I think would be too into the weeds if we got much deeper than that.
All right. We'll leave it at broker and banker, and I appreciate the clarity there. Anything else that you would like to add about your background or you think that would be important for those that are listening to us today?
Yeah, you mentioned we're licensed in a couple states, so I'll just name them so the listeners know. We're licensed in Minnesota, North Dakota, Wisconsin, and for the snowbirds, we're licensed in Florida. Excellent.
Does that mean that you might have a future in Florida too?
Definitely a potential. We were under contract on a property to close in December to do a VRBO,
Okay.
And then the inspection came back not very good, so we had to walk away from that one. But it's on the list.
All right. Well, usually, in Minnesota here, that was something we learned when we moved up here almost 20 years ago, that people do not stay put in the winter. And now we understand, especially as I'm getting older. Well, let's go ahead and dive in here. And so we're on a financial planning podcast, and retirement planning is really the ultimate goal. So most of the time people think 401k, Social Security, things about their investments. But one of the biggest and often overlooked pieces, I believe, as part of this is housing.
Yep.
And so that's what we're going to do in this series. And what we've been doing over the last few weeks is bringing in knowledge leaders on all things housing. And in this episode, what I'd really like to do with our conversation is, yes, it's about real estate, but what's driving mortgage rates? How does the Fed Reserve decisions influence borrowing costs? How rates may be headed in the next 12 to 24 months. And I know that you're going to bring so much more to it. So Sound like a plan?
Perfect.
Let's get into it here. So with the format, if you're good with this, I'm going to ask questions and then you take it where you feel like it's appropriate. And
right.
If I find something in there that I don't understand, good chance our listeners might not either. And so I might ask you some more clarifying questions. But I need your help just right out of the gates talking about rates. And I think this is what everybody probably has on their mind. So tell me, what's driving rates today? And then where do you see them going over the next 12 to 24 months?
Yeah. So I'm going to start with a quick story. To date myself, I was born in 1979. And I was fortunate that my grandparents gave me, I believe it was a $500 CD. at what was then TCF, Twin Cities Federal. It's now Huntington Bank, but I was getting paid 12% in the crib as an infant in my $500 CD.
Yeah.
Fast forward, 21 years. I went to buy my first house with my brother, who's 10 years senior. And he had literally just gotten his MBA in real estate finance from UW-Madison. And this is 2001. And I was in school, so I had the down payment saved up. He had the job. And so I wasn't really a part of the loan because it was his income and credit, just my assets. And I'll never forget, he came home from, I think it was Wells Fargo. And he said, Jay, we've got two options. We can either do a 5-year ARM at 5.5% or a 30-year fixed at 7.5%. And I'm 21. He's 31. We're not in this long term. So I'm thinking, you're going to save the 2% and take the ARM, right? And he's like, no, dude, we'll never be able to borrow this much money for that long of a term at that low rate ever again. And that was 2001. And so, when we were back in the, 7.5%, 8% range, in the last 2 years, people thought it was the end of the world financially, but it's like, that was the greatest deal on earth at the time, 20 some years ago, to somebody that just got their MBA in finance.
Absolutely.
So that's the backstory. So where we're at today is where we'll always be at. And it's going to be, interest rates are going to be driven by two things primarily. One is inflation, and the second thing is unemployment. So if you think back a few years ago, the term inflation, it was transitory. That was the word that Powell had used. It was transitory, meaning it wasn't going to be here to stay. And what we found out was it was here to stay. And so they essentially waited too long to raise rates. And that's why we got the inflation that we got for a number of years. Second piece is unemployment. So the Fed's job, it's a hard one. They're kind of like Goldilocks, like not too hot or not too cold, just right. So they want to keep the economy growing, unofficially at about 2% per year. And they also want to keep unemployment right around 4%. So if inflation gets hotter than 2%, they might have to increase rates. And if unemployment goes up over 4%, then they might have to cut rates because they want to stimulate hiring and investments in the economy.
Yeah. So what is your crystal ball telling you?
The crystal ball is usually, shattered glass pieces around the people with crystal balls. I'll preface it with that, but I think we'll kind of probably stay fairly steady. Inflation had been under control, and then, Iran started, and we saw a big spike in rates after that because the price of gas. I drove down to Omaha this past weekend, and on the way back, paid just over $5 for a gallon of gas in Iowa. And so, if we can get the Iran thing figured out and the price of oil down, then I think we'll see inflation fall back. But if we don't end that soon, we could see inflation and higher rates ahead.
Yeah, absolutely. I feel like there's these little glimpses of hope, and then something else happens that, the next day, and you're like, oh, nope, not at all.
Yep.
And so it does make you think about if you're driving to Omaha or not, as it relates to, what's happening with gas prices. And then that obviously parlays into a lot of other things like homes. And so what's behavior that's happening then? Are people not doing anything? They're waiting, like kind of what's happening with buyers and sellers, both perspectives?
Yeah. So buyers, the interest rates have been quote unquote high for a while now. People got spoiled with 3% rates in 2020, 2021. And when they got up to 8%, like a lot of people thought the world was going to end. But the thing is, when you purchase a house, regardless of the rate, if the market improves, the bond market improves later on, you can always refinance. Yeah. What you can't change is what you paid for that house. Like that's the variable that's not going to change. So the people that were brave and bought when rates were in the 8% range, they've already refinanced 2 or 3 times into upper 5s or low 6s. So you can change that variable. So the people that will take our advice on that, and historically, housing prices have gone up almost every year. There's I think in the last 81 years, prices have gone up 73 times out of 81. Okay. And they've gone down 7 and flat once. So, and a lot of those years were in the recession, the housing crash in 2007, 2008. And so there was like a 3-year period there where a lot of that loss came from. But so historically, real estate's been a pretty safe place to be.
Jay, as you talk about and where you started there with the rates, one of the things that I remember clearly that my dad was talking about early 80s and how much interest rates were at that time. And so perspective is everything, and the lens that you're looking through is everything. But you did a nice job of wrapping that back around to if it is the right thing for you right now, then you have to proceed
Yep.
with your life. And there's always going to be an opportunity, should be an opportunity to make adjustments and refinancing and that side of things. And so bringing this back to real life, I think about, we bought our house in 2014, didn't think we were going to have kids, and how much our home doesn't necessarily fit us anymore. And the conversation that ping pongs back and forth in our house is, first, there's not a lot of inventory. And so if we are going to make a change, you want it to be the right change and kind of that next phase. And then you're sitting on this beautiful rate that you're like, but our house is almost paid off and we have this rate. And so it is an interesting situation that's going on right now. And, back to the lens that you're looking at of first time home buyers versus individuals that have now been sitting for a while looking for homes, and then even those that are going into retirement and kind of their perspective. So there's all different ways to look at this. But I want to drive a little bit and kind of stay on the topic of rates today and some of the developments. So there are a lot of developments right now around the Federal Reserve, including leadership changes here involving Kevin Warsh and the transition from current chair Jerome Powell. So all of that could have a meaningful implication on the direction of monetary policy. So give this to us in really layperson's terms of what might be happening so we keep that conversation going on rates.
Yeah, I'll do my best. And since the Wild had their hockey game last night, I think it was like 9-6. It was one of the higher scoring games of all time in the hockey world. But, the greatest player of all time, most people would say, was Wayne Gretzky, right? And when asked what made him different, is he said, most of the players that are on the ice, they're skating to where the puck is. I'm skating to where the puck's going to be. So he was always thinking ahead. So the problem with, previous Fed chairs and the current Fed chair Powell is they take a rolling 12-month average of inflation and unemployment. So they're not looking at what the scale says today. They're saying, what has the scale said the last 12 months? So essentially they're skating where the puck used to be, right? I think Warsh is going to at least skate to where the puck currently is, maybe not to where it's going to be, but I think he'll be a lot quicker to respond. And that could be a little bit rockier, but ultimately I think it'll be a better overall for the entire economy, because we're not going to be too slow to move in either direction. I think it'll be more rapid movements.
I'll ask a question. I'm putting you on the spot here. Rocky seems unnerving in the world that we're already living in. Do you think people will be able to see through that and see the positives of what you just described there?
Yeah, I think as long as the messaging is clear, saying, part of the reason that we had this inflation run up in 23, 24 was, inflation was transitory. It's because they weren't looking at the data today. They were looking at the 12-month average. And so they weren't reacting fast enough. So if it feels rocky, just know that it's for a smoother road down the road.
That's good. Again, this is what I appreciate about you, is you make things really simple in a complex topic here. And so I'm going to keep us going and talking about what has been happening, and maybe you can help us look forward. But U.S. is shortage of homes is kind of a theme that has been happening for a period now. And it appears there's a big push right now to increase housing supply, limit some of the institutional investors that have been influencing, and then just making affordability a priority just overall. There is specifically right now, there's an act called the 21st Century Road to Housing Act. So whether it's that one or just legislation in general, that is always a risk that could be out there. So walk us through, as an industry veteran, what's some perspective that we should have on all of this, and does it even matter?
Yeah, that's a great question. I'm a free market believer, and the government with the red tape, it just made it very difficult to get things done. So what that bill aims to, I'm just going to touch on three quick things. One is it's supposed to cut some red tape. Whether it does or not will remain to be seen. The second thing is it's supposed to streamline some of the EPA requirements for smaller infill developments. And what an infill development is it could be like we're here in Shoreview, Minnesota. If there's a 2-acre farmhouse from 1920s, it's going to be the developer that goes in and takes that house down and puts in 6 new homes. So that's what an infill development is just taking existing property and raising it and then replacing it with more housing. It's smaller scale. And the third thing is some of the mega corporations that own a lot of the housing stock, they're going to cap any institution that already owns 350 homes from purchasing additional properties. So as a buyer, the competition from BlackRock, as an example,
Mhm.
that will go away.
So should we say buyers are really the ones that will be impacted? Like who's going to be, in just kind of a basic terms, who's going to be impacted by some of this? And do you think it'll all end up going through?
I don't think anybody's going to be that impacted.
Okay.
I think it's just like a small bump on the road.
Okay. So sometimes when we hear these headlines of things that are happening in housing,
Yeah.
they may not even end up impacting
Yeah.
the average person.
It's so hard to have an impact on the average person,
Okay.
right? And I think that's, and a lot of political issues are very divisive, and this
Mhm.
is one of those that was not divisive. It was
Yeah.
like,
I heard
there was
that.
a pretty big majority vote for it. And I think that's because we're leading up to the midterm elections and
Sure.
everybody wants to vote for affordable housing, but I'm not sure what the end result will be.
It seems like there's been a lot of hype around it, and maybe I'm just happened to have caught on to it at a period where it popped up in front of me,
Yeah.
but I can't quite figure out, will it do anything for me? Should I care?
Time will tell.
Perfect. Other trends that might be happening right now that's worthwhile talking about.
So, with inflation and the cost of groceries and gas and everything like that, the families that have been homeowners for a number of years right now, they're sitting on a pretty good chunk of home equity.
Yeah.
And so we've been able to help out quite a few families who maybe have gotten over their skis a little bit in terms of their spending and just repositioning some of that equity to wipe out their debt through whether a cash out refinance or a home equity line of credit to consolidate some things. So that's something that we've been seeing a lot lately.
Because you brought it up, this
Mhm.
is one of those ones, clarification. Will you walk through the compare and contrast those two, but are there more that somebody would be considering?
Um, the the cash out refinance, essentially you have a first mortgage and then maybe some credit cards and a car loan, student loans, etc. You use the equity to pay off all of those debts with one new mortgage. That's what a cash out refinance is
Okay.
you're paying off your current mortgage plus other debts that you have. A home equity line of credit. So if you're sitting in one of those 3% rates from 2000, you don't want to touch that,
Mhm.
but you've got equity, you would take out a second mortgage. So you'd keep your 3% rate in place, and then you get a second mortgage to consolidate the credit cards and the student loans and the car payments, et cetera.
I feel like sometimes you get thrown out a bunch of terms and you don't really know all the moving parts of
Yeah.
it. And so, just one more question around this. Is this when you would reach out to a professional, or do you try to navigate it on your own and dig in and read and chat GPT your little heart out? Like, what do you do?
Yeah, so ChatGPT is funny, and I'll add to that Reddit.
Mhm.
So at our business, we try and track where our clients come from, whether that's a referral from somebody like Nikki or a real estate agent or just a Google search. In the past few months, we had to add to our CRM a drop down in our pick list of referral source, including ChatGPT
Okay.
and Reddit. So there's a lot of do-it-yourselfers trying to figure out all the information on their own ahead of time, and candidly, I think it's the wrong approach. I think you just talk to the professional directly that you trust, because you create all these scenarios that might not exist, and then you have all these questions that might not be applicable. So then you like come to a professional with all these questions, and it's like, I'm not even sure why you're asking me this, other than because ChatGPT said to ask you this,
Sure.
because it's not relevant to your situation. So the best bet's find a professional you can trust and let them do their job.
Jay, what a concept to pick up the phone and actually have a real conversation. I love it. It actually, though, I mean, how refreshing to just get to the point
Yeah.
and tell me what I need to know, and then let's keep moving.
Yep.
Speaking of trends and AI and
Mhm.
ChatGPT and all of that, do you think it's safe to say it's not a trend and that this is where we are going? It is a structural shift. And then how does this impact real estate? And where are you seeing it pop up? Maybe I say real estate meaning I'm looking for a house,
Yeah.
but also your world of mortgages, and just kind of break down where this is showing up.
Yeah. So I think, for the investor clients that are listening, which hopefully they all are,
Yeah.
I think it's going to be a lot like the dot-com bust. There's going to be a lot of companies that people get excited about, put their money at, and then they go to zero.
Okay.
Like, I think there's too much money chasing this trend.
Mhm.
And if you think about all the telecom companies that laid all the fiber and went bankrupt, they paved the way for companies like Netflix.
Mhm.
They basically got free cable, and Netflix was able to capture that. So I think there's maybe not this group of companies that are currently raising all these billions of dollars for AI. It might be the next set in the economy, like a couple years down the road after the dust settles. So I think those will be the winners. So I'm personally cautious on like chasing the next AI trend as an individual investor. In terms of how it's impacting our lives at work, we're very cautious on using it, particularly with client data, because there's really not a lot of trust in the system. A personal example I shared with you, Nikki, before we got on the air today was I flew to Dallas Saturday morning, and my wife texted me a picture of a letter from Columbia University saying my data had been exposed in a breach. And I had nothing to do with Columbia. My wife was like, "Are you taking classes?" But what had happened was, from researching on Grok, that the College Board, which is the company that administers the ACT tests, they had sold people's test scores from 1997, and here almost 20 years later, or it's almost 30 years later rather. I'm getting old.
I'm right here beside you. So you talk about getting old. Here I am too.
Yeah. But I think if there's things you can do operationally, like repetitive tasks, I think it'll be great for that. But in terms of like the actual, your social security number, your W-2, like I don't want big data to know that information.
Yeah. What's your industry in general? You have podcasts or industry events. What's showing up in those conversations? Do you know?
Everybody's excited. There's people that are recording themselves like we're talking right now, and then replacing themselves with an AI generated version of themselves. So they're like putting out content as themselves, but it's their AI, generated version of themselves. So like people are doing that, thinking like, oh, I can send out 10,000 emails to my past clients, and it's going to be my AI version of me, not really me doing the work.
I do have to tell a story on that one if I can real quick.
Please.
So we rewind 3 years ago. I try to do a girls trip once a year with my college friends. And one of my friends, her sister-in-law was really kind of at the beginning of these avatars, I guess, you're talking. She's like, you really should, check into it for what we do and being able to share content in an efficient way. Not a week later after we had done that trip, and I was like, okay, maybe we'll look into this. Somebody had I'm probably not even using the right words, but their avatar, their person, like hijacked, and they were telling, some other story, and they couldn't control it. And I was like, whoa. So we never did anything, but it does, like it comes up. You're like, well, that could be so efficient. And so there's a lot to navigate in all of this, but I think you brought the point back to, let's talk about what we are actually putting in there. And that's the very, basic start of what do you want out there, and then what's going to happen if it gets out there. And so as with anything, proceed with caution and, use some basic common sense as we do some of this.
Yep.
Jay, what else are we not talking about that might be important to talk about as it relates to the things we've shared today?
Yeah, I would say, there's a great quote, don't wait to buy real estate, buy real estate and wait. So if you're on the fence, like the best time to plant a tree was 20 years ago. So if you're on the fence about investing in real estate or buying your first house, talk to a professional, talk to a lender you can trust, a real estate agent you can trust, and have them get a sense of where the market is, and then base your decision on that. It's not a market you try and time. It's like you try and get into it and then let time do its work.
Yeah. I'll just, give a kind of a shout out here is back to the comment on working with a professional, and kind of the way that I'm looking at the world right now is we all need problem solvers around us. And as you talked about, partnering with a professional. Well, Jeff and I were in the position where, we're starting to look at buying buildings and never navigated this before. And there's all kinds of what ifs. And one of the best parts of choosing when, we worked with Jay and had our conversations with Jay about where to go is the simplicity of and clarity that happens when you're working with a professional that can do this, who does this all day, every day. So, we put out, this is where we're going. And you have to have some reality around you. And Jay, I don't know how many times you told me the first time we were having the conversation, this is not going to work for you, Nikki, but, and being hard-headed, I'm like, but I want it to work. But there's so many, efficiency, if you know where you're going and you know what you want, working with a professional that can tell you the ones that we're going to get around the roadblock, or here's some alternatives. It's just invaluable to have that type of relationship. And so, Jay, I certainly appreciate you for a lot of reasons. One, for having real conversations and helping navigate in an area that we know, but we don't really know because there's so many ins and outs. And then also how you can make something complex very, very simple. And so I appreciate that, and how much you know about what's going on your industry. Well, if we don't have anything else that you want to add, just at a very high level, we do have a listener takeaway, and so that I want to share. But before I do that, do you have any sources that you feel like you'd like to send people to, or ones that you keep up on that are, basic enough that a layperson would enjoy listening to something or going to reading, whatever it might be?
Yeah, I am a big fan of Howard Marks. He puts out a newsletter, and it's now available audio as well if you're a listener versus a reader. He breaks things down in a very simple way too. So I feel like part of my simplicity is like observing others that are talking simple terms and just modeling their work, if that makes sense.
That's absolutely makes sense. Why reinvent the wheel, right?
Yeah.
Speaking of this, of having a newsletter version and then having an audio version, I may be way behind, but last week, Notebook LM is a tool that's available out there through Google, and you get so much written content that, yes, you want to absorb it, but you don't have maybe the ability or the time or whatever to sit down and read. And one of the ways that my colleague is using Notebook LM is like take that newsletter as an example from Mark's and putting it into Notebook LM, and then they give you your audio. So when you're driving into work, you can just listen to it. And that's what works in my world right now. I don't have as much time to sit and read as I do to, do that. So if anybody has not looked into Notebook LM, that has been an aha moment for me, that I can listen to a heck of a lot more than I thought I could along the way. And for our offering, to go along with this series, one of the things that we're doing is we are now offering a download each time we do a series. And ours is Should I Pay Off My Mortgage Early flowchart. And you think, oh my gosh, that seems like such a basic, come on, that's not that hard. But it's actually really good. There's a lot of different ways that you can navigate. If I say yes to this or no to this, some other perspective, and it's designed to help with some of the things that we talked about today. But let me ask you, because you are our knowledge leader here, should I put off paying my mortgage early?
The answer is it depends, because everybody's situation is unique to them. Generally speaking, I'd say no. Okay. I've been in the business for, nearly 24 years. And one of the saddest things I remember being a 23-year-old loan officer was going to the couple's house who was in their late 50s or early 60s, whose house was either paid off or just about paid off. And then I'd say, okay, on page 2 of the application was the asset section. It's like, okay, what do you have in your 401k or IRA? And they looked at me with like a blank look. And it's like, we were told to pay off the house first, and then we could start saving. And so a lot of people, it's like, I want to do a 15-year mortgage and get that paid off. But what I found is the most successful people financially basically pay themselves first into their retirement accounts and their brokerage accounts, and max all that out first. And then if you have money left over, invest more or make the decision to pay off your mortgage. But definitely not the highest priority on my list financially is to pay off my mortgage.
Yeah, absolutely.
Like lowest.
Especially when you look at some of the rates that we got into. Not everybody has that option right now. But again, I do think there are variables that go along with this. So if you're somebody that would be interested in getting that download, Should I Pay Off My Mortgage Early, you can visit our website, and I'll go back to that in just a second, but that is available for download. Jay, anything else before we wrap up?
I think we covered a lot of ground, and we'll leave it at that.
All right. And you also did a little foreshadowing of what's to come, I feel like, with talking about having a lot of assets built up in your home. And then what do you do with that? And our next guest is actually a team member of yours. Ben is going to talk a little bit about reverse mortgages. Yeah. So you did some nice foreshadowing there. So with that in mind, if there's anything that you heard today that you think, my gosh, that sounds like me, or you want a second opinion on anything we've talked about, both Jay and our team at Paladin Financial are more than willing to jump on a short 15-minute, no obligation conversation. And so to reach you, Jay, can you go through the best way to do that?
Yeah. Our phone number is 651-315-7681. And then our website is my name. It's www.jaydacey.com.
Jay, you've made it easy. As always, you're consistent with your theme of simplicity there. And you can get to the Paladin Financial team by visiting our website at paladinfinancial.com or reaching us at 651-842-8406. And with that, Jay has social media that he does quite a bit with and is very active with. Jay, do you want to go through your social media as well? And it can be found on our show page when we're done here as well. But yeah, go ahead and share that.
Yeah, you can find me on LinkedIn, and we have an Instagram page that we do a little bit of work with, but LinkedIn is our main platform.
And then are you posting anything to YouTube right now, or do you have anything?
We have some videos on there, some high level stuff like evergreen content that's still applicable today, even though we recorded a few years ago.
Perfect. Well, thank you again for being willing to share your social media. And you can find the Paladin Financial team at on YouTube as well, at Facebook, Instagram, LinkedIn. And we love being able to share bits and pieces of this show as well. And again, to get your download, Should I Pay Off My Mortgage Early? You can get that at paladinfinancial.com and just visit our podcast page. Thanks again for listening. Jay, thanks for joining us. We certainly appreciate it. And we'll see you on the next episode.